Hi, I'm Byron Udell, founder of AccuQuote. Since 1986, AccuQuote has helped millions of people save a fortune on their life insurance. Ever since term insurance was invented, the advice to buy term and invest the difference has been the mantra of many financial pundits, advisors, financial planners, stockbrokers, and even some insurance agents. The question is, does that advice make sense? Or could so many seemingly well-informed and intelligent people be completely misguided? In this video, we'll examine the facts. We'll do the math, and when it's over, at the very least, you'll have more information than when you started, and you'll be in a much better position to evaluate that mantra and determine what's best for you. First, I think it's important to clearly define what we're actually comparing. Let's start with term. Term life insurance, by definition, is temporary insurance. It's typically sold as 10, 15, 20, 25, or 30-year level terms, meaning that, for instance, a 10-year level term has 10 years of level premiums before the rate jumps dramatically in year 11 and goes up from there. 20-year level terms have 20 years of level premiums, and so on. The longer the level term, the higher the annual cost or premium, because the insurance company is, in essence, averaging out the increasing risk of death as we get older, while delivering a predictable level premium for the duration you choose. One major company even introduced a 35-year level term. With level term, when the term period expires, the rate jumps so much, sometimes to as much as 10 to 20 times the level premium you had been paying, that most people simply cancel their policy. Now, that begs the question, what do you do at that point if you still need or want to maintain the coverage? Well, if your health is good, you may be able to buy another term policy. But if your health isn't good, you may not. As we get older, as everyone knows, we typically don't get healthier. Springs start to pop loose and we begin leaking oil here and there. So there's obviously no guarantee that a new term plan will even be available for you down the road when you reach the end of a level term plan's level term. And even if you can qualify for a new term policy when your old one runs out, you can be assured that the premium will be considerably higher than the policy you bought when you were 10, 20, or 30 years younger. Okay, now, permanent life insurance, unlike term, is not temporary coverage, as it's designed to last a lifetime. It certainly costs more, but there's a reason for that, which we'll get into in a moment. The premiums are usually designed to remain level for your entire life, and if it's done right and you pay your premiums each year, it'll remain in force until you die, assuring that your family will receive the death benefit. Now, I've been in the life insurance business for over 30 years, and in that time, I've learned a lot. One of the most important things I've learned is that life insurance is not a win-win proposition between the insurance company and the people they insure. In fact, with almost every life insurance policy that's sold, there will be a winner and there will be a loser. Either you win or the insurance company wins. Now, here's the biggest secret of the life insurance industry. If you want to win the game of life insurance, pay close attention to the following 6 words. Die with your policy in force. You can do this with either term or permanent life insurance, but in order to do it with term insurance, you'll have to die before you're supposed to. Dying young is not something we typically plan for or hope to do. So assuming you die when you're supposed to, around when you're supposed to, around your life expectancy, in order to have your life insurance in force so that you can win the game, you have to own a policy that cannot be canceled by the insurance company before you die, won't expire before you die, and that has a predictable, affordable, level premium that can never be raised by the insurance company in order to force you out before you die. So, getting back to whether it makes sense to buy term and invest the difference, let's do the math, and the numbers will tell the story. For our comparison, let's use 2 of the most popular product categories, 20-year level term and guaranteed universal life. Our example assumes a 45-year-old male in excellent health with a life expectancy of around 86 or 41 more years. The cost for a 20-year level term policy with a $500,000 death benefit, roughly $600 a year. Universal life, on the other hand, with a lifetime guaranteed level premium, same death benefit of $500,000, the cost is $3,700 a year. Big difference, right? And if we invest that difference at, say, 4% after tax, which is equivalent to earning about a 6 to 7% pre-tax return, not easy, but maybe doable, at the end of 20 years, the value of the side fund will be $96,000. Then what? You're now 65 years old, and yeah, your kids may be grown up and out of the house, but you still have a spouse. You're not independently wealthy unless you're fortunate enough to be in the top 5% of the country. You're still working because you can't afford to retire, and you still want your spouse to have some extra money to live on when you die, because $96,000 just isn't enough. If you had the term insurance and the side fund of $96,000, you might think, well, let's just get another 20-year level term. So let's look at that. If you're still reasonably healthy, of course, half the folks at age 65 are not, between cancer, heart disease, diabetes, or something else, but let's just say you dodged all that and you're still reasonably healthy enough to qualify for a standard risk class. To replace that $500,000 of coverage with a new 20-year term, the cost would be roughly $14,000 a year. Now, of course, your $96,000 side fund would cover the first 7 years or so of that policy, but then you're back to having to pay out of pocket $14,000 a year. And even so, that policy will last exactly another 20 years, bringing you to age 85. Now, let's say you live to age 86 like we talked about before, which is about the life expectancy of a healthy 45-year-old. So your coverage will have expired at age 85, and trust me, if you try to replace it at that age, you'll be so shocked at the price, you might have a stroke right then and there. Forget about it. You're going to die without life insurance. No one will get the $500,000. You will have paid $600 a year for the first 20 years. That's $12,000, plus $14,000 a year for the next 20 years. That's $280,000, for a total of $292,000 for 40 years of term insurance. And you end up collecting nothing because you died exactly when you're supposed to, 1 year later at age 86. Can you see why the insurance companies love term insurance? Now, on the other hand, if on day one you had bought a permanent universal life policy with a guaranteed premium of just $3,700 a year, through age 85, you would have paid in just $148,000 plus another $3,700 for that last year, age 86. So you'd be all in for the 41 years at $151,700. Then you die, and your spouse or children or grandchildren collect $500,000 income tax free. You tell me, what makes more sense? Buy term, invest the difference, spend multiple six figures on your life insurance only to die without any insurance in force, or buy a guaranteed universal life policy with a level premium for life and die with the life insurance totaling over 3 times what you paid for it. It sure seems like an obvious, easy decision to me, yet so many arguably well-meaning and misguided financial pundits would rather tell you to just buy term and invest the difference. Why? I don't know. Perhaps they just haven't done the math. I just know they couldn't be more wrong. I've been doing this for over 30 years. I have hundreds of thousands of clients, and I've had thousands of clients die during that time. Not a single beneficiary of any of those death claims has ever said to me, you know, we don't need this insurance money. This is too much money. We'll never be able to spend it all. Or can you take some of it back and give it to someone who needs it more? Or I can't believe how much we paid for this and how little we got back in the end. Folks, that just never happens. Remember, again, life insurance is not a win-win proposition. There's always a winner and there's always a loser. And if you're one of the winners, you don't have to feel sorry for the insurance company. It's actually all the people who bought policies that didn't end up collecting because their policies didn't last long enough to be around when they died, that end up subsidizing the ridiculously high rates of return for the people who are smart enough to own and keep their policies until they die. Now, there's no question that term insurance serves a valuable purpose and solves a lot of problems temporarily, but not permanently. And there's a good reason that term insurance policies are so cheap. Statistically, only 1.5% of them actually end up paying a death claim because they lapse or expire before you die. I hope this information was helpful to you. Of course, the numbers vary depending on your age and health, so if you have any questions or want to see what the numbers look like for you, just give us a call at the number on your screen or visit AccuQuote.com. Thanks so much for listening.